Hey everyone, thanks for checking in our latest Trade to Black podcast. Earnings season? Nope, it's not done yet. We still ongoing with a lot of companies still reporting, including a week and a half ago, Chicago Atlantic had their latest numbers, and we've said on a few live streams in the past that we plan to have Peter Sack back on to dive into it and why it's important, because really with Chicago Atlantic, it gives us a better idea and overall as far as the industry is trending right now and what some of the borrowers are currently experiencing here in the industry. So with that, let's welcome an AV as we get set for an earnings report. But this is always a good barometer, so to speak, to kind of get an idea as to, yes, what they're doing, but what we're seeing trending wise as an industry as a whole, right?
Yeah, it's nice to get a pulse check on the industry, especially from the Chicago Atlantic REFI side and then the Chicago Atlantic BDC or LIEN side of the business. Both differentiated lenders in the space, and it's a great litmus test as to the overall health of the industry, especially with Peter's point of view.
So let's find out what that health is. Let's welcome in managing partner, Chicago Atlantic, Peter Sack. Chicago Atlantic trades on the NASDAQ under the ticker symbol REFI. Good to see you, sir. How are things?
Doing great. Great to see you guys.
I know you've had a busy couple of weeks, not one, but two companies, obviously, in the latest earnings report. But before we get into yours specifically, have you gotten a chance to look at the industry as a whole, and what's your takeaway from what you're seeing trending wise, or even had an opportunity to see some of the other stuff?
Yeah, we spend most of our time with private companies, but it starts at the top, and the trends that start at the top, sometimes they start at the top and bleed their way down, and sometimes they start with smaller companies and bleed their way up. So it's important to look at both at the same time. From earnings reports this year, it seems like a lot of uncertainty is driving a lot of trepidation and a lot of inaction, I would say.
Yeah.
Positive of that is that I'd say there's a strong focus on operations and operational efficiency and optimization. I think that's the good spin on it. The negative spin on it is that there is less risk taking.
Yeah.
There's less M&A, less inorganic growth, less, and the ambition is there, but the action on the ambition isn't necessarily happening.
How would you best describe the private side? That's the public equity side, but what are you seeing from as far as the private side?
On the private side, there's a lot more nimbleness.
Yeah.
And there is less sensitivity to equity valuations as a driver for action or inaction. The private side companies, I think, can take a longer term view of cost of capital than the public operators can. And they can make decisions. They do make decisions based on a smaller set of numbers. So the private actors can buy 2 dispensaries, and that makes a meaningful change to their operations, or 6 dispensaries, and that makes a meaningful change. A private operator can decide to build those dry rooms, those optimized dry rooms that they've been putting off for a long time, but now believe is the right time. And those can make meaningful changes to a business of a small operator that, for a large operator, this may not be a focus. And particularly if a large operator is going to say, you know what, we're not going to make M&A activity for the next 6 months, that means that it all stops, including those small things that can be really accretive if you're in the market looking to understand them and hear them.
Yeah, makes sense. Well, from what I'm gathering then, more on the private side, these are decisions that are made more longer term versus a lot of the public equity sides. And I know we've had a lot of feedback to say, like a lot of our investors and viewers, how do we get involved in some of these private deals where it's right in front of you, which is obviously your REIT. And that's the reason why we have you on from time to time, not only to talk about the industry, but to really shed light on some of these opportunities that the average retail investor may not have access to. So with that, let's dive into some of your latest numbers. Q1 2025, net interest income approximately $13 million as of March 31, 2025. This is compared to $14.1 million as of December 31st, 2024. Total expenses approximately $4.1 million before provision for current expected credit losses, representing a sequential decrease of approximately 28.3%, and net income of approximately $10 million or 47 cents per weighted average diluted common share, represented a sequential increase of 20.5% on a per share basis. Those are some fancy numbers. So break it down to us and simplify it for the average investor on what it means and how would you best describe what your latest earnings were?
Yeah, absolutely. For REFI, revenue declined slightly sequentially on a portfolio that was largely stable in size. but earned less largely because of prime rate declines that occurred in Q3 and Q4 and saw a full quarter's impact in Q1. And then on total net income, REFI experienced a significant increase in net income in this quarter on total net income, driven by release of reserves.
Okay.
This is something we're extremely proud of. We completed the foreclosure of a loan in a business that had been on non-accrual for some time. And with that foreclosure, we were able to show the market how a lender does actually execute on its rights and privileges in the case of a downside scenario, and in the case of a downside scenario where you have an operator that's not willing to find compromise. And as we go on, we'll be showing the market how REFI is able to execute on earning money off of loans post a foreclosure. So today, Chicago Atlantic is operating the business.
Yep.
Okay.
The balance sheet has been restructured, and expect the loan to be earning income sometime in the following quarters.
How are you thinking about capital allocation on a go-forward basis? I mean, like you'd alluded to, when you look at the publics right now, you're seeing stagnation amongst the fundamentals. The privates, most of them don't have to deal with those problems for the most part. Then the way that they're structured, what markets are you looking at, and what assets are you looking at, let's say, in capital deployment moving forward, if any, in the States, and or are you looking abroad in terms of potential assets?
On a state-based thesis, the state-based theses are focused on Ohio, Missouri, Maryland. And then now, while we can execute on a state-based thesis, that doesn't mean that we're not spending time in other places. It just means that that time spent in other places isn't based necessarily on a macro thesis of the state. It's based on the opportunities of specific operators that are operating there, their success, and their specific plans. And so that could be retailer consolidation in Arizona, as an example.
Right.
Yeah.
That could be retailer consolidation and build out of dispensaries in even a place like California, where there are mature dispensary operators that have shown success or built significant earning streams and are now consolidating less performing operators. That can even be mature markets like Massachusetts, to the extent that you find someone where you can underwrite the performance of the market today and the performance of the market should there be further declines in wholesale prices, and get comfortable with a debt thesis.
Do you think we could potentially be looking at a consolidation cycle here in the next couple of years amongst those private assets? I'm assuming you can match the balance sheets much easier than you could, let's say, the pubcos right now, which would have a very decent problem in matchmaking if you wanted to look at the leverage. But do you think that we're going to overall experience consolidation as an industry as it starts to greatly mature in the face of hopefully reform?
Oh, I think it's already happening. There's
Yeah.
a lot of private consolidation occurring in Missouri. Plenty of private consolidation has already occurred in Arizona. Some of the largest private companies that are executing on this well, Good Day Farms, Story Companies, two large successful private companies that are in a very disciplined manner creating partnerships, executing acquisitions.
So what did translate that? What's that mean for you then and your company? Like, how would you approach this?
We're extremely comfortable lending into M&A transactions, and so we can be a part of that. We can be a part of solving that transaction by providing additional cash to help that transaction happen.
Do you plan to stay in that lane? And when you look at some of these assets that could come available, that could be cheaper than what they were 3, 4, 5 years ago, is this something that you guys would consider, like, down the road, or is this something that you just don't want to step into that arena, so to speak?
We like to support our. Well, first of all, when we need to step in and operate a company, we certainly will, and that ends up supporting the entire capital structure. But in general, we prefer to support our portfolio companies in their plans for M&A and their plans for growth. And we've done that in certain circumstances. A good example is a portfolio company, Varrell, to
Okay.
which we've been a lender for a long time. And in Q4 of 2024, we supported them in the acquisition of 3 other cannabis companies across the country.
Taking the keys of the company, we've seen, let's say, one of your peers as of recent come under a lot of scrutiny and stress due to an overweighting within their portfolio to a single tenant. Um, within the current portfolio of assets and within your underwriting process, do you sensitivity test not to get too deep into one tenant to avoid those kind of situations and take more of a diverse approach?
Oh, absolutely. Um, Absolutely. I mean, our largest positions that we have in the portfolio across REFI and LIEN,
Mm-hmm.
we don't seek to increase above those sizes. And diversification, I think, is a key reason for our existence. This is why investors hire us. This is why investors invest in our funds. Not
Right.
only can we find single great investments, we can build a diversified portfolio of investments to execute over time. And as a platform, this is a key reason for Chicago Atlantic's existence. That by being part of a broader platform that has an extremely strong originations team and large and scaled underwriting team, we can bring a diversity of sourcing and pipeline and give that exposure to each of our funds and spread that exposure across each of our funds that allows each of our funds to build diversified portfolios in a way that would be a lot more difficult for them if they were operating independently, if one of our funds was operating independently.
Hmm.
And with that approach, I'm assuming you see a lot of, or you get a lot of touch points with institutional investors, family offices, and other asset managers wanting to deploy into the space. They do like value. I'm sure the ones that are paying attention do see what's going on. Is it becoming a lucrative time, or are you starting to see more interest in those investors engaging in the conversation around just the industry as a whole from where it's at from a value perspective, since we've been so beaten down, especially if you look at the valuations on the public side?
Yep.
Or does that not translating to the private?
I think for investing in debt funds, the conversation is relatively the same because
Okay.
we look to provide uh, attractive risk-adjusted returns regardless of where the cycle is, and we're looking to and so the flip side of that is that when MSOS has earned 30% in a year, we're still pitching investors in a fund where we're deploying in the high teens.
Okay.
And that high teens and that consistent return looks looks more attractive over a period of time when MSOS has declined by 90%.
Yes.
So it's two sides of the coin.
There's always two sides to a coin, and it's tough, obviously, getting some of these retail investors in the space. But we've always communicated that time and time again. But that's something worth noting, right? Yeah. Want to switch now to interest rates. We've had a few people on recently that have talked about refinancing their debt, pushing it out. We had actually Boris Jordan on earlier this week, and he was mentioning about he feels like there's time, and he believes that interest rates are going to be slashed by perhaps the end of this year or going into next year. When I look at right now, roughly 60% of your loans remain at a variable rate. And as I said, expectations that we could see a shift in interest rates at some point here in 2025. So with that, how are you thinking, I guess, about protecting margins if the Feds do indeed start cutting more aggressively?
Yeah. So for the existing portfolio, we focus on in the existing portfolio, we originate our loans generally at a floating rate with a prime rate floor that's equal to the existing prime rate floor. So that when we originate deals, our fund and our investors are exposed to increased income should rates rise, but income does not decline when rates fall. And so that's been successful in limiting the impact of rate declines over time across the portfolio. When I think the challenge with cannabis companies is that their interest rates as a whole are somewhat decoupled from the risk-free rate.
Yeah.
Okay.
And that's in part because the rates that cannabis companies pay, for better or worse, is so much higher than the broader economy.
Of course.
And so if you're paying an effective cost of capital of 16%, if interest rates go down by 75 basis points, that doesn't actually change your economics on a percentage basis so differently. And that's distinct from the broader private credit markets, where if we were an ordinary BDC or an ordinary mortgage REIT, we would be really excited if our portfolio had a 12% average return. And if interest rates go down by 1%, that has a meaningful impact on a portfolio yield of 12%, and it has a less
Sure.
meaningful impact on our portfolio returns of between 16 and 17%.
Right.
One of the major numbers that stuck out to me on the REFI print was the decrease in expenses by 28.3%. Was that an initiative for the quarter? And do you foresee any more decreases in SG&A and overall expenses for the rest of the year?
Yeah, I think we're constantly thinking about how do we find more efficiencies in terms of how we operate the vehicle,
Mm-hmm.
and how we allocate expenses, to the vehicle. And so you're constantly trying to find the best ways of execution.
Well, best ways of execution. We know there's capital constraints and a lot of regulatory friction on a state-by-state basis with the industry. How would you, I guess, outline or basically express in a lot of ways how you're approaching risk today versus, say, compared to a year ago? And are you seeing any new types of risks emerge right now?
I'd say I'm not sure this really changed from a year ago, but our debt investments have to be predicated on the assumption that there will be no new equity investment going into XYZ company.
Okay.
Because you can't assume that A, the equity capital will be available, or that B, the operator will be excited about taking that high cost of equity capital.
The smart
Well,
strategy.
very smart strategy. You also maintain a 100% payout ratio this quarter with the 47-cent dividend matching EPS. Meanwhile, book value per share actually ticked up. Saying that, how do you balance shareholder returns through dividends, say, retaining earnings for growth or well-timed investments? Because this is impressive.
Oh, well, that's easy. We've committed to our investors that we will distribute close to 100% of all earnings for the whole year. So it's already
Promises made. Yeah,
Mhm.
promises made, promises kept.
Yep.
It's a easy thesis. Then on the other side of the business, we had LIEN, the business development company, report earnings this week. For those that don't know, what's the fundamental difference between the mortgage REIT and the BDC in terms of how they can allocate capital within the cannabis industry?
Two fundamental differences. One, the mortgage REIT needs to have the preponderance of its investments be backed by real estate. The BDC in that regard has a more flexible mandate. It
Okay.
tends to focus on cash flow based loans rather than real estate loans. But it's limited in terms of concentration risk it can take, and it's limited in terms of the amount of debt that it can deploy to public companies, in particular public companies with a greater than $250 million market cap. So different limitations on each. Fundamentally, the mortgage REIT is focused on real estate backed loans, and the BDC has a bit more flexible mandate in terms of real estate and non-real estate backed facilities. But ultimately, in the case of both vehicles, we're taking first lien positions secured by all assets of the company. In the case of REFI, not just real estate, and highly limiting the amount of subordinated debt that can sit behind us, such that we're the most significant piece of the debt capital stack. And what comes with that is a focus on underwriting to the ability to repay indebtedness, and that for us is defined most significantly in terms of cash flow. And
Gotcha.
the cash flow will change, and the diversity and dependability of that cash flow, which is largely driven by their footprint, by the markets that they're operating in, and the actions of the operators themselves.
Makes sense.
With the dependency on cash flow, I'm assuming there also becomes a certain sensitivity to allocating towards a certain asset class, whether it's retail, distribution, cultivation, vertical integration. With that BDC, is there a certain asset type that you're looking for, or a certain asset type that performs better than to underwrite for when it comes to allocating capital?
Absolutely. We're focused on limited license jurisdictions first and foremost.
Gotcha.
And within limited license jurisdictions, we tend to be partial to either vertically integrated businesses or pure retail businesses. We find that having retail exposure and that direct link to the customer mitigates the risk of wholesale price compression and competition in wholesale markets.
Okay.
So, have you been paying much attention what's going on in PA with the state Senate and possible adult use passing? Like, how are you approaching that state in the event that we do get some, let's fingers crossed, get some positive news? Because Lord knows this industry needs it right now from new markets going live. But in the event that they do get adult use, how are you going to approach that market itself?
I think we've already invested significant amounts in Pennsylvania historically.
Yep.
It's been an attractive medical market, in particular on the retail side. And I think historically, we've invested in every medical market. We've invested assuming that there's no change in the landscape, that adult use never comes, and that the medical market continues to exist in whatever form we think it's going to exist. And so until it becomes really certain, until the law is passed, that's
Yep.
the same approach that we're going to take with deploying capital in Pennsylvania. When it does turn adult use, and it looks more and more likely, and it looks more and more likely that will not be a state-run store model, we'll be really excited to increase that deployment. And I think we're going to see.
That got shut down pretty fast, which is nice to see. But we were speaking with Michael Bronstein of Attach a few times, and he was making it very clear that this is going to be dead on arrival. And sure enough, a week later, that was indeed the case. But good to see. But curious to see, like I said, if it were to pass, how would you best approach this market? We're actually almost a year in now since adult went live use in Ohio. There's been learning curves. How would you best describe the Ohio market over the past 12 months? Because you said limited licenses. This is a state, obviously, that presents that. And you probably have your ear to the ground as to how things are maturing in that market. How would you best describe it?
Yeah, I think it's difficult to predict a specific dispensary, how it will perform.
Yeah.
It's hard. Sometimes you'll get it extremely right. Sometimes you won't. What we have seen in Pennsylvania is that even dispensaries that began their adult use journey with lower expected volumes, that they've seen an ability to grab customer share and grab market share by execution, and that the market in Pennsylvania does seem to be maturing slowly, and I think it's still growing. And customers are learning to find their favorite store, find their favorite products, find their favorite buying patterns. And I'll be excited to see the next big change in Pennsylvania will be greater deployment of pre-rolls.
Okay. That'll be big with that product category for that market. You also closed on a new $100 million senior secured revolving credit facility within the LIEN vehicle that was announced with the quarter. Any plans for that? Was any of it pre-allocated, or is that kind of just surveying the land, looking at the industry on a go-forward basis, and I guess allocating appropriately moving forward?
We are extremely excited to deploy that over the coming year.
Okay.
We raised it with an aim to deploy it.
And are you looking at hemp at all? Whether it's the beverage space, whether it's some of these other opportunities within the space, is that on your radar, and even within the purview of, let's say, the mandates within the funds and within the BDC?
Yep, absolutely within our mandate, within our purview, keeping a close eye. I think from a debt standpoint, we tend to focus on cash flowing scaled companies of a certain scale. Mm-hmm. And to date, there are not very many of those within the hemp space and the hemp beverage space. But we're keeping an eye out to see those who are to potentially partner with some of the best operators in that space too.
Yeah.
Well, I
Europe,
think yeah.
Is Europe on the radar? Or does Europe classify within the mandates?
It does, but I think Europe has just a different credit market than the U.S. does.
Gotcha.
Banks are more prevalent in Europe generally as a part of the broader private credit market. Even forget about cannabis. And then because cannabis is federally legal to some degree in Europe, in specific jurisdictions in Europe, it does grant them more access to credit capital than exists in the U.S.
Gotcha.
And I think the combination of just a less developed private credit market, a more developed banking market for private credit in general, and the difference in federal legality in Europe makes it just a less attractive credit market from a U.S. lender's perspective.
I think it's always important to remind our audience, too, that in the event we get reform here in the U.S., many people believe that traditional banks are going to come in, swoop up, and take away a lot of the competition. But when it comes to our underwriting, it's very complicated with this industry. So based on relationships with traditional banks and the backgrounds that you guys have, what does that landscape look like in the event that there is reform? And will they lean to, I guess, companies like yourselves based on direction, knowing the amount of years of experience that you have? It's important for people to understand this.
Yep. So I think it's framed a little bit incorrectly. Banks are, since the 2008 financial crisis, are a relatively small proportion of the broader private credit space for medium-sized businesses.
Okay.
I think what would be really powerful for changing access to credit in the U.S. would be the Small Business Administration providing loans to cannabis companies, the broader private credit market being able to provide credit to cannabis companies, and unfortunately, that's only going to come when we're much closer to full legalization, or perhaps something like the States Act.
Yeah. It's funny you brought up the SBA, because someone actually posted the SBA guidance on Twitter earlier this morning, and the SBA actually has federally legal hemp businesses included in their guidelines for lending.
Wow.
I'm not sure what the acceptance rate is on those businesses, and as I'm sure the scrutiny is very stringent on them, but I was surprised to actually see that hemp was allowed within the guidelines of the SBA for lending.
Yep, it's amazing.
Yeah.
It's one word for it,
isn't it? Time to book a coffee with Senator Tim Scott. That's what I think.
Yeah.
But listen, always appreciate, before I let you go, 40,000 foot view, whether it's the Pubco side, private side, what do you think? How does this industry mature from your perspective over these next 12 to 24 months?
Yeah, I think we see more consolidation. I think we see better focus on operations and cost control. And positives are going to come from Pennsylvania adult use, and positives are going to come from rescheduling. Fingers crossed.
Yeah. Hopefully,
for sure. Hopefully we get some good news in a couple of years in both your backyards, which is Florida, because that seems to be getting louder and louder once again. But let's not get ahead of ourselves. But listen, congrats obviously on the numbers, and nice payout ratio, as I said, 100%, and consistency. As much as we look at 17 to 18% returns, that's consistent month over month. And we always try to educate some of our viewers on slow and steady wins the race a lot of the times. And there's nothing wrong with that, but especially in a volatile industry like cannabis. But always good catching up with you to get a state of affairs on the industry. And then most importantly, just what you're seeing both in the private and public side. But let's keep in touch, okay?
Likewise. Appreciate you having me on.
Thanks, Peter. Appreciate your time.
Bye.
Hey everyone, thanks again for watching. Listen, we're almost at 50,000 subs here on our YouTube channel. So if you just watched this podcast and you haven't subscribed, make sure to do so now. We'd very much appreciate it. As usual, like and leave your comments below, and let's keep this conversation going. Any questions, feel free to reach out and we'll get back to you. In the meantime, enjoy the rest of your day. And thanks again for watching our latest Trade to Black podcast. Thanks, everyone.